At some point, someone is going to hand you money that is not yours. Maybe they already have. You said yes, you signed something. And now there is a number attached to your name that you have to make disappear. That is debt. But not all debt works the same way. Some debt builds things. Some debt destroys things. Some debt is so normal that people forget it is debt at all. Here is every kind of debt, what it actually means, and what happens if you do not understand it. Secured debt. This is debt that is backed by something you own. If you stop paying, they do not just call you, they take the thing. A mortgage is secured debt. Your house is the collateral. A car loan is secured debt. Your car is the collateral. Picture this. You lose your job. 3 months go by. The calls start. Then the letters. Then one morning, there is a tow truck in your driveway and your car is gone before you finish your coffee. That is what secured means. The lender felt safe giving you money because if everything falls apart, they have something real to collect. That security is also what makes secured debt cheaper. Lower interest rates, longer repayment periods, bigger loan amounts. The trade is simple. You put something on the line, they give you better terms. The danger is forgetting what you put on the line. When life gets hard, secured debt does not wait, it collects. Unsecured debt. This is debt with nothing backing it up. No collateral, just your word and your credit score. Credit cards are unsecured debt. Personal loans are unsecured debt. Medical bills are unsecured debt. Because the lender has no asset to grab if you default, they charge you more for the risk. That is why credit card interest rates are brutal compared to mortgage rates. The lender is taking a chance on you, and they price that accordingly. Here is what most people get wrong about unsecured debt. They think no collateral means no real consequences. It does not. If you stop paying, they cannot take your couch. But they can wreck your credit score, send debt collectors to your door, and eventually take you to court where a judge can order your wages garnished. No collateral means no assets seized. It does not mean no problem. The consequences just arrive differently, and sometimes slower, which makes people think they are not coming at all. They are always coming. Revolving debt. This is debt with a limit that resets as you pay it down. Credit cards are the most common example. You have a $5,000 limit. You spend $2,000. You owe $2,000. You pay it off. Your limit resets to $5,000. You can borrow, repay, and borrow again in a continuous cycle. That cycle is the product. The bank is not offering you convenience. They are offering you a loop that never has to close. Most people with serious credit card debt did not max out their card overnight. They had a few expensive months, a car repair, a medical bill, a slow season at work. They carried a balance. They paid the minimum. Then another expense hit, then another. 2 years later, they are paying $150 a month on a balance that barely moves because almost all of it goes to interest. The loop does not feel like a trap when you are in it. It feels like managing. That is what makes it so effective. Installment debt. This is debt with a fixed payment schedule. You borrow a set amount. You repay it in equal installments over a set period. Student loans, car loans, personal loans, mortgages, all installment debt. The structure sounds simple. You know what you owe, you know what you pay each month, and you know exactly when it ends. But installment debt has a trick most people fall for. When the monthly payment feels too high, lenders offer to extend the term. Same loan, longer repayment period, lower monthly payment. Sounds better, is not. You just agreed to pay more total interest in exchange for smaller amounts spread over more time. The monthly number went down, the total cost went up. Extend a car loan from 4 years to 6 years, and you could pay thousands more for the exact same vehicle. The finish line did not get easier, it just moved further away. Student loan debt. This is the debt people take on before they have any idea what debt actually means. At 17 or 18, someone hands you a form. You sign it, you go to class, you study, you graduate. Then the bill arrives. $40,000, $60,000, sometimes more, for a degree that might be paying you $35,000 a year to start. Student loans can be federal or private. Federal loans come from the government. Lower interest rates, flexible repayment options, access to income-driven repayment plans, and in some cases, forgiveness programs. Private loans come from banks and lenders. Higher rates, less flexibility, no forgiveness. The problem with student loan debt is not just the amount, it is the timing. You are taking on the largest debt of your life at the exact moment you have the least financial knowledge to understand it. Nobody sits you down and explains what compound interest means at 18. Nobody tells you that a degree in a field with a $30,000 starting salary and $60,000 in private loans is a financial decision you will be living with for the next 20 years. You find that out later, usually at the kitchen table, usually alone. Mortgage debt. This is the biggest debt most people will ever take on. 6 figures, sometimes 7, paid back over 20 or 30 years. A mortgage lets you buy a home by borrowing the purchase price and repaying it monthly with interest. The home itself is the collateral. Miss enough payments, and the bank takes it back. That process is called foreclosure. It means losing the home, destroying your credit, and in some cases, still owing money after the house is sold. Most people think of their mortgage as just a monthly bill. It is not. It is a multi-decade financial commitment with your most valuable asset on the line every single month. And here is what the bank does not tell you. When they approve you for a $400,000 mortgage, that number is based on what you can technically afford, not what you should spend, not what leaves you room for emergencies, investments, or a life outside of housing payments, just the maximum you can technically service. Buy the house you can actually afford, not the one the bank says you qualify for. Those two numbers are almost never the same. Credit card debt. This is the debt that sneaks up on people. You did not plan to have it. You just had a few expensive months. One card, one balance, a minimum payment that felt manageable. Then the interest started compounding. The average credit card charges somewhere between 18 and 24% annually. That means a $1,000 balance left unpaid for a year becomes $1,200 without you spending another cent. People underestimate credit card debt because the minimum payment feels small. It is designed to feel small. The card company calculated that minimum payment specifically to keep you in debt for as long as legally possible, while technically being able to say you are not in default. Pay the minimum on a $3,000 balance at 20% interest, and you will be paying it off for over a decade. You will pay nearly double the original amount in total for things you bought years ago, things you probably do not even own anymore. Medical debt. This is the debt nobody plans for. You do not choose it. You do not sign up for it. You do not negotiate the price before you agree to care. One hospital visit, one diagnosis, one emergency at 2 in the morning, and suddenly you owe more than most people make in a month. Medical debt is unique because it arrives as a consequence of something that was already terrible. You were already sick, injured, or scared. Then, weeks later, a bill shows up that makes everything worse. In many countries, medical debt is the leading cause of personal bankruptcy. Millions of people with insurance still end up with medical debt because of deductibles, out-of-network charges, and coverage gaps nobody explained when they signed up. Here is what most people do not know. Medical bills are often negotiable. Hospitals have financial assistance programs. Payment plans with zero interest are common. The stated amount on the bill is frequently not the final amount, but none of that happens automatically. You have to ask, you have to call, you have to push. Most people pay the full bill because it never occurred to them that they could pay less. Payday loan debt. This is the most expensive debt in the financial system. You borrow a small amount, usually a few $100s, against your next paycheck. 2 weeks later, you pay it back with a fee. That fee, when calculated as an annual interest rate, is often 300 to 400%, some higher. People use payday loans because they have run out of every other option. No credit history, no savings, an emergency that cannot wait, a broken down car that needs to be fixed by Monday, or they lose the job that pays for everything. The loan solves the immediate problem. Then payday comes. They pay back the loan, the account is short. The same emergency that triggered the first loan is now compounded by being short after repaying it. So they take another loan, and the cycle begins. Payday loan debt is not a mistake people make. It is a system designed to keep people who are already struggling spending what little they have on fees and interest instead of ever getting ahead. It is legal. It is predatory, and once you are in it, getting out requires breaking a cycle that is specifically designed not to be broken. Auto loan debt. This is the debt most people treat as completely normal without ever stopping to think about what it actually costs them. You want a car, you do not have the cash. You walk into a dealership, a salesperson sits you down, and within minutes the conversation stops being about the price of the car and starts being about the monthly payment. Can you do $450 a month? What about $500? The monthly payment feels manageable. The total cost of the loan does not come up. Here is the problem. The car you borrow money to buy starts losing value the moment you drive it off the lot. Depreciation and interest are both working against you simultaneously. You are paying more for something that is worth less every single day. And then comes the trade-in. Every few years, the dealership offers you a newer model. Lower monthly payment, better features. They roll whatever you still owe on your current loan into the new one. You drive away feeling like you upgraded. You actually just reset the debt clock and agreed to owe money on a car you no longer own. This cycle can repeat for decades. Some people are in their 40s still paying for cars they drove in their 20s. Personal loan debt. This is a lump sum borrowed from a bank or lender and paid back in fixed monthly installments over a set period. People use personal loans to consolidate credit card debt, cover large expenses, or handle emergencies. The interest rate is usually lower than a credit card, but higher than a mortgage. On paper, using a personal loan to consolidate credit card debt makes sense. Take 5 cards with an average interest rate of 22%. Roll them into one personal loan at 11%. Cut the interest cost in half. One payment, clear timeline. In practice, here is what usually happens. The cards are paid off, the balances are zero, and within 12 months, the cards are full again. Now there is the personal loan and the card debt. The loan did not solve the problem. It just cleared the scoreboard temporarily, while the spending habits that created the debt in the first place kept running in the background unchanged. Business debt. This is money borrowed to start, run, or grow a company. Business loans, lines of credit, equipment financing, investor debt that comes with repayment terms. Unlike personal debt, business debt is often framed as a tool rather than a burden. And sometimes it is. Borrowing to buy equipment that generates twice the loan in revenue is rational. Borrowing to expand into a market you have already proven works is rational. The problem is when the distinction between investing and surviving collapses. When a business borrows to cover payroll because revenue fell short, that is not a growth investment, that is survival on credit. And if the revenue does not recover, the debt stays. The interest keeps compounding. The operating costs do not drop. Most small businesses that fail do not run out of ideas, they run out of cash flow. And business debt used to plug cash flow gaps rather than fund genuine growth is one of the fastest ways to accelerate that outcome. Tax debt. This is money owed to the government for unpaid taxes. It can happen by accident. You underpaid, you miscalculated, you missed a filing. Or it can happen deliberately. You hid income and got caught. Either way, tax debt hits differently than every other debt on this list. Most lenders can hurt your credit and drag you to court. The government does not need to wait for a court. They can go straight to your paycheck, your bank account, your property. No warning letter from a debt collector, no negotiation window, just a lien, a seizure, or a garnishment, and you find out after it happens. The saving grace is that most tax authorities would rather collect than punish. Payment plans exist. Settlements for less than the full amount are possible, but only if you engage. Ignoring tax debt does not make it smaller. It makes it larger, faster, with penalties and interest stacking every month you wait. The people who end up in the worst situations with tax debt are not always the ones who owed the most. They are the ones who saw the number, panicked, and did nothing. Doing something, anything, is almost always better than silence. Every kind of debt, all of it money you borrowed that has to come back, with interest, on a schedule, under terms someone else wrote. The kind of debt matters, the interest rate matters, the terms matter, but the most dangerous thing about debt is not the amount. It is not the interest rate. It is not even the payment schedule. It is signing something you do not fully understand and living with that signature for the next 10, 20, 30 years. Most people are carrying debt they cannot fully explain, paying obligations they never properly read, to lenders who understood every word of that contract before you signed it. Now you understand it too. That is where it starts.